now to Nigeria. Nigeria's Monetary Policy Committee today decided to leave the country's benchmark interest rate unchanged at 27%, despite the sharp decline of the headline interest rates to 16.02% in October. The rates setting the committee of the central bank a decision to hold the headline rate and other parameters unchanged was based on due consideration of inflation, GDP growth, as well as the fiscal balance as well. But the MPC, however, reviewed the standing facilities corridor to plus 50 and minus 450 basis points around the key policy rate. Let's take an excerpt from the post-MPC briefing by the Central Bank Governor Olayemi Kadoso.
The committee decided by a majority vote to maintain the current monetary policy stance with an adjustment to the corridor as follows. 1. Retain the monetary policy rate, MPR, at 27%. 2. Adjust the standing facility corridor around the MPR at plus 50 to minus 450 basis points. 3. Retain the cash reserve requirement, CRR, for deposit money banks at 45%, merchant banks at 16%, and 75% for non-TSA public sector deposits. And 4, keep the liquidity ratio unchanged at 30%. The committee's decision was underpinned by the need to sustain the progress made so far towards achieving low and stable inflation. The MPC reaffirmed its commitment to a data-driven assessment of developments and outlook to guide future policy decisions. Considerations. The committee welcomed the continued deceleration in headline inflation year on year in October 2025 for the 7th consecutive month. This favorable development resulted from several factors, including sustained monetary policy tightening, stable exchange rate, increased capital flows, and surplus current account balance. In addition, the relative stability in the price of premium motor spirit, PMS, and improved food supply supported the pace of disinflation.